Well, the first question is, do you need to do a self-assessment tax return? You will do if you tick one of these boxes. Are you self-employed? Did you earn £2,500 or more in untaxed income in the last year, such as from rental property? Did you earn £10,000 or more from savings or investments? Have you received profits from assets subject to capital gains tax? Were you a company director? Did you receive dividends over £10,000? Or did you receive child benefit while also earning more than £50,000? If you tick any of those boxes, you need to register with HMRC. You can do that online. Well, you can still do it on paper, but most people do it online at HMRC's website or via some accounting software. When you're going to file it, what information do you need? Well, you need your unique taxpayer reference. This is a reference that HMRC will have sent you when you registered for self-assessment. Without it, you can't file your tax return. You then need your financial records. So if you're self-employed, you'll need to know all of your sales and your expenses to ultimately be able to work out the profit you'll be paying tax on. That will be the same. You'll need records of any dividends you've received, rental properties, any other income, basically, so you know what figures you're putting on the tax return. If you're employed, that would be your P60 from your employer, which basically adds up all your salary for the whole year. Or if you left a job halfway through the year, you need your P45. Well, everybody has the same personal tax year. It runs from the 6th of April to the 5th of April. And then you get to the following 31st of January to file your tax return. So for the year ended 5th of April 2018, you get till the 31st of January 2019 to fill in your tax return and also pay the tax on it. Now there is actually an exception there. If you do choose to do it on paper, the deadline is the 31st of October. So aside from it being easier to do online, you actually get longer to do it. Now the deadline might be the 31st of January, but it makes loads of sense to do it earlier. You've got the information, and if you do it earlier, you still don't pay the tax till the 31st of January, but you know how much it is, and if need be, you've got time to save for it. Well, there's an immediate £100 fine if you miss the deadline at midnight on the 31st of January. That applies even if you're 1 second late. You then get a few months, but from the 1st of May, you get charged an extra £10 per day for 90 days, i.e. up to £900 extra in fines. When you get to the 31st of July, i.e. 6 months late, there's another £300 added. A year later, and another £300 is added on top of that. And as well, there'll be a percentage of the tax owed and interest as well. So as an example, if you're over 6 months late, i.e. after the 31st of January, you'll be fined a minimum of £1,300 plus the percentage of tax and the interest as well. So it's well worth getting it in on time.